All right, happy Monday, everybody. Lots of tariff news on the board here, so let's get right into it and see how it affects our mortgage lives and our real estate lives. So here we go. So the US and the European Union have a tariff deal structured. It's not inked yet. It's important to note that. Same with the deal that we had from Japan from last week. It is not inked yet, so we have to wait and see how it all shakes out and actually gets inked. Now, what's going on? Tariffs on European Union imports, traditionally for the US, have been about 1.5%. They are now 15%. It's important that we notate that we import about only 14% of our goods from the EU. So the inflation impact, I'm guessing, is going to be around 2% to us. However, there's a lot of experts that talk about that the consumer should only see zero point 0.2 to zero point 0.3. I don't know if I'm buying that, simply because there's an assumption that the importer that pays those taxes will absorb some of those things and not pass it on to the consumer. I haven't seen corporations be very benevolent as of late, so I don't know. The auto industry. So this is where we had a 10% tariff on cars that we sent to the European Union, and now they're at 2.5%. Good news on the front end. We got to keep in mind that only less than 2% of the US made cars sell in Europe. It's about 200,000 units. Where I think the win comes, especially for those of us who have European car problems, is that the European Union reduced its import from 27.5 to 15%, reduced rather its tariff from 27.5 to 15%. Keep in mind again that about 23% of the cars that we consume and we buy and we use come from the EU. So roughly about 800,000 units. So this is good news if you're a European car buyer here in the United States. Not so much. I don't see a whole lot of money being made on 200,000 units, going from this to this, but who knows? Maybe. Bottom line, expect a small uptick, if you will, in consumer prices if this thing actually gets inked the way that it sits. Now, what's going on in our market here? We're trading in a pretty tight little range here and have been since about the end of June, early July. You see, they're just kind of sticking around right around this 50 basis point difference between here and here. This is why you're seeing rates be flat week after week after week. For this week, really the jobs report will determine the direction of mortgage interest rates. Stay with me here. So JOLTS job opening and labor turnover statistics, that's a mouthful for me every time. It's expected to drop by 200,000, meaning that there's going to be that much less jobs available than there was last week. We'll wait and see. ADP that processes around 250 million jobs or paychecks each month. It's a precursor to the BLS jobs report. That's forecasted for 78,000 new private sector jobs. The BLS report, again, that's the official thing that the market's waiting on. It's got a forecast of 110,000 jobs. So let's see if that happens. And unemployment rate is expected to tick up this time from 4.1 to 4.2. I think if we see an unemployment rate around 4.4, 4.5, that's when you're going to really start to see some erosion in the market and be able to give these mortgage bonds a little bit of help. Because remember that weak job data means potential bond rally, which means lower rates. If the jobs report comes in strong, higher rates await us. So this space is really important to watch. Sure, by the way, to follow on our Instagram account, because I'm going to be making updates on these reports as they are released on Instagram. Okay, the rates. A couple weeks ago, they're 6.83%. Today, 6.81%. These rates, as I even said it in January, I think we're going to be floating somewhere right around that 6.75 to 7 something and back and forth. So it's not going anywhere aside from that. Okay, well, have a fantastic week. As always, subscribe, like, comment, share these things so people can be as smart as you are. And if you need anything, we're just a phone call away. Have a great week. Bye-bye.